Greetings to all, and welcome to the virtual launch of the 2023 Carney Foreign Direct Investment Confidence Index, which this year we entitled Cautious Optimism. On behalf of Carney, thank you very much for joining us today. We have friends and colleagues from no less than 34 countries represented in this session. My name is Eric Peterson, and I have the privilege of serving as Managing Director of Carney's Global Business Policy Council. I'm also one of the co-authors, together with my colleague Terry Toland, of this year's report. Before we begin formally, a couple preliminary points on the governance of today's program. The event is on the record and will be available on the Carney website after it concludes. For those of you wishing to join the conversation on social media, please use hashtag FDICI on Twitter and LinkedIn. Today's event will consist of a briefing on the results of our index, followed by a discussion of our thematic section. This year it focused on the state of globalization, together with colleagues and friends Per Hong and Patrick Van de Bosch, both of whom I'll introduce briefly and whose more detailed biographical data will be sent to you at the end of our session here. We will close with discussions with a Q&A session. So if you'd like to ask a question, we kindly ask you to use the chat feature in this WebEx, or that you send an email to gbpc@carney.com. At the conclusion of this launch, we will send you full details on how to access the full Foreign Direct Investment Confidence Index report. Ladies and gentlemen, we're proud that this year we mark the 25th anniversary of the FDI Confidence Index. When we first launched the report in 1998, it was the first of its kind in terms of examining forward-looking indicators of direct investment flows. The FDICI is a survey of global business executives who play a decisive role in the FDI decisions of their respective companies. It is not Carney's judgment. And rather than focus on historical data over the years, and it continues to be this way, our survey of global investors was and is designed to be forward-looking, that is, to examine companies' FDI intentions, as well as broader FDI investment trends that we could expect to see in the next 3 years. Our survey has a strong track record in picking up not only attractive FDI destinations, but also in terms of identifying macroeconomic and business environment trends that are just beginning to materialize at the time of the survey, but only become apparent in the years ahead. In addition to our global rankings, this year we are introducing an emerging markets ranking for the first time ever in the history of our index. We hope that this will provide some additional insights regarding investor preferences in countries that tend not to appear regularly on the global index itself. In today's presentation, I will be sharing the country ranking results from our 2023 index before exploring some of the additional findings regarding investor sentiment and outlook. After that, I'll look at some of the top-line findings from our thematic section, which this year explores investor perspectives on the state of globalization, as I've mentioned, before opening up a discussion to our esteemed panel. So, without further ado, here are the market rankings for the 2023 FDI Confidence Index. The United States again tops the index, holding the first place position for the 11th year in a row. Canada and Japan take the second and third place respectively. Germany drops 2 notches to 4th place, while the UK maintains its prior year ranking of 5th place. As mentioned, we entitled this year's report Cautious Optimism to reflect the overall somewhat positive sentiment on the economy and FDI outlook in general. And here, for example, we see that 13 countries moved up in the ranking compared to last year. In addition, when we assess the change in the weighted score reflected on the right of this figure, we find that scores increased in 8 of the top 10 markets, but only rose in 5 of the bottom 15. This suggests that investors, while open to exploring new markets comparatively lower in the index, remain most confident in what they see as the safe bets at the top of the rankings. Along these lines, developed markets account for 19 of the top 25 spots on the index. This marks the 5th consecutive year that each of the top 5 positions in the rankings have been held by a developed market. We believe that the reason for this is that these markets continue to show their strength in our survey during periods of acute economic and geopolitical volatility. Representing the highest jump in rankings this year is Singapore, which made a striking increase from 18th to 9th place, likely on the back of its higher than expected growth in 2022, which reached 3.6% and far exceeded the advanced economy average of 2.6%. Investors were perhaps also optimistic about improvements in the country's tech exports, which appear poised to increase amid rebounding external demand. European markets once again retain the greatest regional share on the index, with 12 of the top 25 countries. As significant as that portion is, it does represent a decline from recent years, as 14 European markets appeared on the 22 list and 15 in 2021. And this could be due to the recessionary pressures facing many of these markets at the moment, or amid the current geopolitical turbulence and high inflation affecting the region. Asia Pacific has the second strongest showing, with 8 markets represented in our index, up 2 from 2022 with the addition of India and Thailand. India's reemergence on the index at 16th after a 3-year hiatus is noteworthy and is likely spurred by the country's very robust growth prospects, with expected growth averaging 6.3% over the next 3 years, far exceeding the global expected average of 2.5%. Thailand's reemergence at 23rd place after a 5-year absence from our index is due in part, we believe, to its economic resilience and its tourism sector recovery and private consumption remaining the major drivers of growth. The Americas sees the US and Canada make the very top of the index again this year. And the Middle East and North Africa is represented by 3 markets, with Saudi Arabia 24th, joining Qatar 21st, and the United Arab Emirates 18th. We are now pleased to introduce for the very first time our emerging market rankings. And here, China, India, the United Arab Emirates, Qatar, Thailand, and Saudi Arabia hold the top 6 positions. They are also the only emerging markets included in the world rankings. Beyond these top 6 positions, Latin America makes a very solid showing, with Brazil, Mexico, and Argentina taking the 7th, 8th, and 9th place positions, respectively. Southeast Asia also performs strongly, with Malaysia, Indonesia, the Philippines, and Vietnam taking the 10th through 13th positions, respectively. Their strength, along with that of Thailand, could reflect an uptick in investors diversifying their supply chains to boost resilience in a period of heightened geopolitical uncertainty. We now dig a little deeper into the optimism rankings that our respondents had for each country and region, as well as investor sentiment on the global economy and other regulatory and market factors that affect their foreign direct investment decisions. While levels of pessimism this year ticked up slightly from 32 to 35%, nearly two-thirds of investors, some 63%, remained more optimistic than pessimistic about the outlook for the global economy. And this was precisely the same level that we had last year. For our world rankings, investor optimism is highest for Canada, and then Japan, then the United States, then France, and then Singapore. This again shows that business leaders perhaps prefer the stability of developed markets in trying and obviously challenging economic and geopolitical circumstances. In assessing optimism in our emerging market rankings, the Middle East swept the top of our emerging market optimism, with investors most bullish on the UAE, Qatar, and Saudi Arabia. Asia Pacific also had a strong showing. China, India, Thailand, and Malaysia following close behind in terms of investor optimism levels. In this slide, we can see that investor optimism really comes to the forefront, with 82% of companies saying that they plan to increase their foreign direct investment levels in the next 3 years, compared to 76% the year before. We saw similar results with other questions pulsing investor sentiment, including the finding that 87% of investors cited foreign direct investment as more important for their corporate profitability and competitiveness in the next 3 years, a modest increase from 83% last year. Yet the responses to this question show that investors also have a degree of caution regarding the year ahead, and for good reason. They cite price increases, a potential increase in geopolitical tensions, a potential rise in political instability in an emerging market as the most likely risks that they might encounter. These concerns are likely the result of continued Russia-Ukraine conflict and the continuing reverberations of the pandemic, as well as subsequent commodity price volatility and persistently high inflation. Indeed, global inflation reached a striking 7.8% in 2022. And while we all note that the level is currently declining, is still anticipated to remain above 5% this year in 2023. Investors remain most invested in developed markets, as noted, and are continuing to seek investment opportunities in them, with emerging markets close behind. And this year, we also asked investors about their attitudes and reasons for choosing not to invest in a certain market type, developing, emerging, or frontier. And what we found was that the results varied widely. Availability, or presumably lack thereof, of raw materials and other inputs was listed as the top reason, some 40%, why investment in developed markets was not being considered. And no surprise, political instability at 38% was listed as the top reason by far why investors were not considering placing foreign direct investment in emerging markets. And finally, investors cited infrastructure quality at 36% as the main reason blocking their decisions or intentions to invest in frontier markets. And finally, before we move to the results of our thematic section on globalization, we can see here that for the second consecutive year, the top 3 factors that investors prioritize when choosing where to make their FDI flows decisions are transparency of government regulation, technology and innovation capabilities, and tax rates and ease of tax payments. This stands, we believe, to reason, as the value in transparent regulations and innovation capacity have proven to be particularly beneficial during the pandemic period, and the subsequent geopolitical dislocations that we've seen in recent times. For this next section, I will lay out key takeaways from this year's thematic section. As I've suggested, each year we have a thematic section which provides an opportunity for us to do a deeper dive with respect to investor opinions on a specific subject area that we believe is particularly important to business leaders. And this year, for the 2023 index, we selected the outlook for globalization, or in other words, how investors view the current and future trajectory of global interconnectedness. Overall, the results reveal that investors believe that globalization is and will remain the central force in foreign direct investment, but they also acknowledge that the environment is changing. Here we see that a distinct majority, some 66% of respondents, anticipate an increase in globalization over the next 3 years, whereas less than 1/4 expect a decrease. Looking at these results from a regional standpoint shows some notable differences in perspectives. While a majority of investors across all regions anticipate an increase in globalization, as I've suggested, this is most pronounced in the Asia Pacific area, where 73% anticipate this, followed by the Americas region at 69%. In contrast, just 58% of European investors hold the same view. Perhaps this is attributable to the ongoing geopolitical conflict of the region and the perception that rising trade barriers, the most cited factor in Europe for a decline in globalization, may materialize. Among the 66% of investors who anticipate an increase in globalization over the next 3 years, it was noteworthy that the most cited reason for this increase was the rise in connected digital infrastructure. This finding reflects the fact that digital trade in services, especially for telecom and IT, surged during the pandemic, as we all know, even during lockdown periods when other trade flows struggled. Investors appear to have taken note and are increasingly aware of the pivotal role that connected digital infrastructure and the connectivity serving to support digital trade and services and globalization more broadly over the next 3 years and beyond. Among the 23% of investors who anticipated not an acceleration, but rather a deceleration of globalization in the years ahead, there was concern about increased trade barriers, continued supply chain disruptions, and a less stable geopolitical environment. These 3 factors were viewed as most significant. For these reasons, global headwinds continue to be top of mind, and for very good reason. Rising self-sufficiency measures have caused friction among key trading partners. We see it, for example, in the US and the European Union, and global supply chain pressures remain largely elevated over pre-pandemic levels. A sizable portion of investors are indeed tempering their optimism in light of continued economic and geopolitical circumstances. Finally, though investors overwhelmingly believe in the benefits of globalization, as we've suggested, to the tune of 77%, they also believe that more regionalization is likely to emerge in the next 3 years. In addition, investors indicated that they believe governments will need to become more self-sufficient, that they will need to build higher levels of resistance. These results suggest that investors do not anticipate an unwinding of the globalization process, particularly what we've seen over the past 3 decades. However, they are cognizant that it is the fundamental nature of the process is changing, with increased nearshoring, friendshoring, and a rise in industrial policies. We believe that business leaders will increasingly face pressures to adapt to these changes if they are to succeed. So with that, by way of a briefing on the major results, it's now my opportunity to ask our esteemed panelists some questions about the Foreign Direct Investment Confidence Index and the findings that relate to their specific areas of expertise. And after that, as I've indicated, we will be opening up things to you to ask questions. Now, as I've suggested, we've got two terrific panelists, Patrick van der Bosch and Per Hong, both of whom have extensive credentials that the details will be sent to you immediately after this session. So I'll just, gentlemen, I hope you'll forgive me, but I'll just provide short introductions for you. Let me first turn to Patrick for his views on the results of our thematic section. Again, forgive me for the quick introduction, Patrick, but Patrick is a senior partner, is the architect of the firm's very important reshoring index, and has a commanding heights view on global supply chain trends. So, Patrick, appreciate that you could be with us today.
Sure.
Given your extensive work on Kearney's reshoring index, how do you reconcile investors' relatively bullish sentiments on globalization, as I've described them here, versus the growing popularity that we're all seeing of nearshoring, friendshoring, reshoring over the past few years?
Well, I mean, they're not mutually exclusive in a sense that different companies and even entire industries are responding very differently to all these supply chain challenges that we've all experienced over the last few years. If I were to bucket them up, if you will, I think there's typically three types of models that you'll see companies deploy. One is where they move from a global supply chain to multiple, what I would call multi-local supply chains. They're still connected through some global governance function, but they're really in the market and for the market. A second model that we see often is what I would call regional self-sufficiency. It's the aim there is to have, for instance, Europe as its own sort of bubble of interconnected supply and demand nodes, and with a lot of more reduced dependency on imports from these long, fragile value chains that we've all seen fall apart, frankly. And then the third group are the ones that are maintaining some of their key production facilities in Asia, China, or other Asia-Pacific countries like Vietnam, India, and so on. And they complement that then with scalable production bases that are a bit more closer to the target customer markets in Europe or the United States. So I think there's a place for both manufacturing closer to the markets as well as for globalization. But it'll be in a different format than what we've seen over the past few decades. I'm sure you've all heard companies talk about China plus one, and now we're increasingly talking about China plus X, with X being 2, 3, whatever, right? What that indicates to me, though, is that there's still China there. So there's definitely a drive to become less dependent on just one location, but we're not really seeing a wholesale exodus from China. In fact, several companies, especially global ones, that have already reshored or nearshored as part of their have still part of their manufacturing operations in China or in other overseas locations. And actually, we're even seeing now some companies and industries, like for instance, base chemicals, refocusing some of their attention and a portion of their investments to China. It's probably why you're seeing China climb up the ranks of the Foreign Direct Investment Confidence Index again. Those companies have struggled to meet profitability targets as they've shifted out of China. So I'd say, at least for the foreseeable future, or until something very drastic happens, globalization and near, or friendshoring can easily coexist.
Patrick, you've already mentioned a number of key markets. You mentioned China and the improvement that it had on the rankings, the FDI rankings this year. And you've mentioned some other regional countries in East Asia, but the way you see it, you have such a unique perspective on this. Who are the winners and losers? Which countries are benefiting the most from this process, and why? And what would, we have a lot of countries represented on this call.
Yeah.
And what factors would you call out, to be important?
Well, I mean, it's changed a little bit over the last decade. We actually put the reshoring index out there for the last 10 years as well. So we also have an anniversary. We're still infants compared to FDICI. But if you look back a little bit, up until a few years ago, that push to reduce dependency on just one country, basically China, was really benefiting other Asian countries initially, with Vietnam in particular seeing some staggering growth numbers, obviously from a very low base. Now, Vietnam is starting to get a bit saturated, and other countries in the region, companies are finding require some significant investments in infrastructure or changes in the way they're doing business. With all that, Mexico suddenly has become increasingly popular, especially since USMCA was put in place. Now, Mexico is not without its challenges, but the experience they have with supplying the automotive industry in the US and the overall ability to meet those very high quality standards from that industry is really starting to draw a lot of interest. And already we've seen Mexico's imports into the US increase by 17% just in the last year. And then as we turn to the US with these various, I'd call them carrot and stick type policies that the US government is now putting in place, and the fact that increasingly we're now seeing US consumers who basically are at the end of every extended supply chain, we're seeing them willing to pay extra for Made in USA. That's starting to change things and attract more interest among companies to bring manufacturing back to the US. In fact, domestic gross manufacturing output, the number was just out this morning, and it's one of the elements that goes into our annual reshoring index, and it's up by 14% versus last year. So by comparison, since we started tracking this in 2013, if you anchor that as 100%, basically, we only went up 7% across the whole period from 2013 to 2021. And now the last year, we've gone up 14%. So that tells me that there's a lot of activity going on in the US right now.
Great. Thank you. Thank you, Patrick. Now I'd like to bring in another senior partner and dear friend of our council, Per Hong. Per is a senior partner at Carney and is also our resident geopolitical and global supply chain expert, and has done a lot of work in that connection with the World Economic Forum. I'm sure, Per, you can fill us in a little bit on that. Thank you, Per, for being with us today, both great friends of our council. Given the recent global shocks that we've all been watching, Per, from the pandemic and all the geopolitical tensions that have been generated in multiple regions across the world, how do you see it? How do companies best protect their extended supply chains in the face of so much uncertainty?
Well, Eric, thanks very much and it's a pleasure to be here and to be able to speak on this. And the context of the foreign direct investment release that you've made this morning, I think in the overall context of the environment in which we're operating is important. The global economy in 2022 faced yet another year of, I feel every time we have these discussions, I overuse the word unprecedented challenges. Inflation, labor, resource shortages, logistics bottlenecks, energy price surges all dominated the news last year. And as we enter yet another year of disruption, whether it's fueled by COVID-19, geopolitical tensions, the global impacts of climate change, leading companies that are leading in this environment, that are winning in this environment, have built and are building capabilities, embedding resiliency as a core design principle to continually navigate this new environment of turmoil and volatility. And more importantly, in the context of the findings that you've shared this morning, that I'm deeply intrigued by, are reassessing how they are allocating capital and directing investment. I think for the first time in decades, it's fair to say that we're operating in a business environment that is marked by scarcity and competition for supply. It's a supply-driven environment and not just a demand-driven one. And as we're moving into this supply-constrained environment, the work that we've done with the World Economic Forum that you've referenced, surveying over 250 senior executives on their sentiments and how leading companies are are building capability, we see 5 trends that are shaping how companies are reconfiguring and rewiring their operations. One we've touched on, Patrick. You talked about this pivot a bit from global to globally connected, multi-local value chains to diversify their operations. Globalization is by no means dying. In fact, it's very much alive, but it is being reshaped, and we are rewiring operations in that context to bring supply and demand closer together, to help build resilience, to reduce lead times in transportation, boost overall flexibility and agility. We, in the work that we've been doing, 85% of companies that we've been surveying and engaged with indicated they're making changes to their global footprint in order to be able to start to build and drive that. The second key trend, also aligned to some of your key findings, a real pivot from just doing digital to being digital across end-to-end operations in order to build these types of capabilities. 98% of the executives that we've engaged indicated that they're increasing their investments into AI, into the Internet of Things, into automation to help control the cost pressures that are endemic in an inflationary environment, to digitize operations, to build transparency and visibility, which in turn helps identify and react to these key disruptions as they're occurring, as well as to help build in the analytics and the diagnostic capabilities to help create more self-healing types of value chains. The third key trend around a real pivot from economies of scale to what we're calling economies of skill. We estimate 2 out of every 5 workers require reskilling. In this environment of new digital capabilities, further scarcity of talent, upskilling is required to regenerate the talent base, to help boost innovation, to improve the availability of talent. And that continues to be a key driver of where investment is being directed. And the last 2 trends, that I'll briefly touch on, that we can come back to. One, that the importance of continuing to sustainability is moving from a nice to have to a must have increasingly. We're increasingly hearing how that's stepping up to the top of the agenda, and there are geopolitical reasons for that. There are economic reasons for that, as we think about regenerating operations and regenerative operations that are required to minimize the risks and improve the visibility that's required there. And then finally, this pivot to being closer to consumer, which underpins much of the globalization repivots that we've been describing.
Per, thanks for that great response. Striking to me how many words you used that began with the letters RE, regenerate, rewire, etc. And it's really true. It's emblematic of kind of the remaking that we are seeing now of significant systems. And what's also striking to me is that implicit in this regeneration, this self-healing, as you called it, is the notion that things might stabilize in a couple of years. And I think that might underpin some of the optimism that we saw in our survey. Let's keep our fingers crossed that we do see that kind of an improvement. But I find that really, really interesting. Maybe if you'll permit me, I'll get you to focus a little bit on a specific region. I know that you have expertise in multiple regions, but let's focus a little bit on Eastern Europe. Do you think that the geopolitical turbulence there will continue to affect investor confidence in European markets in the years to come? What's your take on this?
Well, I guess, and we should start and first acknowledge, Russia's invasion of Ukraine, which began 13 months ago, has irrevocably changed not just the lives of millions of people, but also the overall investment climate to the business environment that exists in Europe. It's the largest land conflict in Europe since the end of the Second World War, and it goes without saying that it is sending shockwaves, redefining the global economy and security in the process. The first anniversary passed last month, and as we reflect on your question around how does it continue to impact investment confidence in European markets, there's no question it has been reshaping much of those pieces. And I was intrigued by the finding that you shared, as you demonstrated, that Europe retains the greatest share of the top 25 markets. There is still optimism and desire for investment heading into Europe. But as we look at that, I think we need to think about, and what we observe, be open, thinking about looking at individual opportunities, not just on a market as a whole when it comes to deploying investment or driving capital, because not all sectors face the same issues in all countries. First and foremost, the military action in Ukraine has caused a humanitarian crisis. More than 8 million refugees have been recorded across Europe. This places financial burden on many of the social structures that exist in these countries. 60% of those are, in countries that border Ukraine, but also are opportunities for development and restructuring and support that's required. But I think the most noted change as we're thinking about Europe is of course, the energy sector. The challenge that the crisis has created in Europe. If today's energy crisis hadn't cleared up any remaining questions about the need to transition to renewables and to drive investment, I don't know what else governments in the private sector need to see. If climate change had failed to convince anybody, then certainly the security of supply issues that the Russian invasion highlighted underline the imperative to be able to now invest and drive development in these renewable and alternative sectors definitively. And certainly amidst the higher prices and the push for finding alternative supplies to Russia last year, we did see investment moving into the market to be able to reduce that dependence, LNG investment, as well as new sources of renewable energies, I think, which was another cause for different types of investor optimism, if you will, but cautiously, to use your terms. And I think the third dimension, you referenced as we were talking about the perception of stabilization, or what happens 3 years, or whether that's optimism or a false hope. But there will be an end to this crisis in a resolution in one way or another. And the tragedy that has occurred in Ukraine and in the surrounding countries will need to be rebuilt. There will be a need for investment and development going forward. So as I look at my perception on the European markets, as I reflecting on my own career that has taken me in both Eastern Europe and Western Europe and elsewhere, there are a lot of structural reasons why investment will continue to flow and needs to flow into these key markets. And I think probably reflects why in your findings that Europe continues to remain and retain an important spot of investment cost and investor confidence.
Let me open up a question to both of you, if I may. In the light of all of the variables that we've been talking about here, and the signals that we're getting from the Foreign Direct Investment Confidence Index and the Reshoring Index, and the developments on the ground that we're all watching day by day, what are the kind of key elements that we need to be emphasizing to the private sector? I know that there are no silver bullets here, but nevertheless, what are the kind of big ticket lessons that we can pull out of the results of this index, number one? And number two, what advice might you provide to the leaders who responded the way they did to this survey in terms of thinking about the outlook?
Well,
Patrick, what do you think? Yeah.
I'll maybe answer this from the perspective of supply chains, basically, and then specifically the ones I've been looking most at that end up somewhere in the U.S. at some point. I think, despite all the investments in AI and technology, whatever, I think we still sometimes forget that really good supply chains rely on really good people with the right skills. And so, one of the things that we see constantly at the top of the list when it comes to getting any return on any investment, but specifically in supply chain, is being able to attract the right type of talent, and that goes well beyond things like salary and career progression, and is more about what kind of environment are you creating for these people. So I would say wherever you invest, whatever part of the world, you're always going to find that talent is more and more scarce than it's ever been. And specifically when it comes to supply chains, the skills that are required to operate those are becoming more and more, quote unquote, high tech. Even the traditional blue collar in the plant is no longer just a blue collar. There's like a tech blue collar. In fact, maybe we'll see some of the ex-Googlers and Amazoners end up in plants now. And those folks are used to a very different work environment, and you ignore that at your peril if you want to tap into that kind of pool. So I would say talent is probably one of the biggest ones that should be factored in whenever you make an investment to make basically get the value from that investment.
Eric, do you want to add to that? Yeah.
I'll add to that. The other key theme that jumps out to me is a reflect on the findings and the discussion that we're having today. One of the key lessons emerging out of the disruptions that we've experienced over the last 4 years is, particularly from a supply chain view, is a recognition that resiliency, the ability to be able to continue to succeed and gain share and continue to survive in this market requires leaders to rethink not just supply chains, but value chains end to end. And this notion of being able to connect the success of my supply chain depends on the success of your supply chain and your partner's supply chains. And so the investment that goes into transforming how the private sector is interacting with both upstream value chain partners and downstream value chain partners, whether that's across platforming, portfolios, really thinking through the supplier communications and visibility across my tier, not just my tier 1, but my tier 2 and tier 3 suppliers, optimizing my production networks to provide transparency into supply gaps so I can begin to pivot and move sources of supply to continue resiliency and drive that investment, automating some of the key elements as we mentioned, but that end-to-end thinking, which necessitates that I cannot just operate in a single supply chain. I cannot operate in a single market and be successful, but it's an ability to be able to connect in different markets in different ways to be able to supply and support the global, connect globally in order to be able to produce locally becomes an important element that kind of carries through that end-to-end thinking, and a reason why the investment being directed becomes so critical.
On both your points, we've had a question that I think touches on them, but it gives you an opportunity to do a little bit of a deeper dive. And the question is, what are your thoughts about the outlook in the coming years on the potential of emerging technologies to build efficiency and reduce costs in supply chains? Perry, you talked about some of the big areas of technology innovation that you focused on and your work with the World Economic Forum. And Patrick, I know that you're focused on this as well. What specific emerging technologies would you guys identify, and what do you think? How do you think people should be positioning to take advantage of them?
Well, I mean, obviously AI is all the rage right now, right? Everybody's got their Chat GPT. Maybe next year you'll be writing the FDI CI with Chat GPT. Who knows, right? But honestly, I think even when it comes to just basic automation, you know, and I would say the more and more affordable version of that, being able to deploy that in a way that adds efficiency and not complexity is quite critical. And one of the things we found, for instance, as companies are trying to do that, is that they're struggling with the fact that they have so many different types of products in the market, and that's not easy to automate, right? So all these technologies basically that you have out there have some limits. And so just deploying a technology without addressing some of the challenges that hit on those limits, I think will not work. And that's why we see you know, companies still struggling basically to deal with the tail end of whatever it is they're making and setting up a supply chain for that. So to me, it's yes, look at all these technologies, and as they mature, more and more of these will become useful, but also look at the rest of your business to see how do you extract maximum value out of those technologies.
In a disruptive environment and an investment climate that we're describing, that we're operating in, the need for transparency, visibility, connectedness, the ability to be able to sense the demand shifts, to be able to anticipate those risks is fundamentally, it is a fundamental capability, and hence where a lot of the new technologies, you know, AI, Internet of Things, even some of the automation technologies that you've described become critical. But I guess it's also worth mentioning that there's, you know, while there's, you know, a boundless potential promise of what digitization can bring and to be able to help support and react and manage through that, there are some sobering truths that also exist when it comes to the technologies themselves as well. Certainly, digitization creates further risks of cyber attacks, and in the same environment in which we're operating, we've also seen, you know, an increase of cyber crime and pieces, and, you know, automation increases dependency on energy, and the very point, Patrick, that you made previously, which I very much agree with, is, you know, digital talent is in scarce supply, and so we very well might need, you know, in that environment, you know, Google programmers operating in factories is not a stretch, but that's the world in which we're operating. So the promise and the realities, you know, as it relates to a digital, fully connected, transparent solution are not always aligned, and I think those are also factors we should be keeping front and center as we're moving forward into a future.
And if I may add one more point to that, I think every company out there is still collecting way more data than they're ever using. So any technology that extracts more value out of what they're already pulling together and invested probably millions of dollars to collect is going to help them finally leap forward and get that return on that investment. And we're still seeing a lot of companies struggle with that.
Yeah, that's a great point, Patrick. Yeah, really good. We're getting a very good flow of comments and questions from the participants in this session. And I'd like to encourage you to keep sending them in to us, please. We'll try to take as many of these as we can in the time that we have left. But we're getting quite a few of them. We're getting some questions about the degree to which respondents to the FDI CI survey were bullish on the prospects for globalization, especially in the context of what I think we can all stipulate is a turbulent operating environment in which we're going right now. And a couple of them have focused on the weak economic prospects for this year, 2023, not only for many of the developed markets, but also for developing markets. And one question in particular asks whether investors are likely to diversify their investments to include a different mix of the developed market concentration that exists right now, and might take into account some of the emerging market forecasts that we saw. Let me take a shot at that, and I'd be grateful if you would both kind of weigh in with your own perspectives on this. But first of all, let me say that I think that it would be you would be hard pressed to find anybody who expects this year to be anything but challenging in terms of the growth prospects. We're about to generate our first half 23 global economic outlook at our council. We'll be releasing it in a couple of weeks. And the outlook for this year, the global output is at about 1.4, 1.5%. That's a significant decline from where it was last year at about 2.8, 2.9. And then we roared back from the pandemic the year before at 6.1%. And our projections for the period after that ain't much to write home about. We expect to see some degree of recovery in 24, 25, and then kind of a flat trajectory for global economic growth through the end of the decade. That, of course, hides regional and national stories, of course. For example, at the national level, we expect India to roar back to significant growth, and we expect Asia, Australasia as a region to outperform all the other regions. But then again, it's going to be a significant complexity in terms of cherry picking where the growth is likely to be and how to take advantage of it. And all this will tie in to the broader supply chain dynamics that Per and Patrick have been describing for us. So I think that, and I think that this year's meteoric rise, if I may call it that, of Singapore in our rankings attests to the fact that if you have strong economic policies and regulatory frameworks, that you can kind of move into that significant sweet spot of growth on the one hand and opportunity at the same time. But how do you both see this? What do you think in terms of how we regenerate, to use the word that Per brought up, from our current economic circumstances? What do you think?
Well, I mean, on supply chains right now, diversification is definitely the name of the game. One challenge with that is that adds redundancy. That's the whole point of basically becoming more resilient. You have, some extra spare capacity here, but that's expensive, right? And so that's going to be one of the biggest challenges that companies are going to be grappling with, is how do you basically manage the extra cost that comes with that extra resilience, that extra redundancy that you've built in by geographically diversifying where you plunk down your plants and different parts of your supply chain. So that could either help or hurt in a way that if companies really figure that out and use some of the technology we talked about earlier to get that efficiency to a level where it compensates for this extra cost, then I think we're in for some really gangbuster economies. If they struggle with that, it's just going to add to things like inflation and make things more expensive, and that's going to be tough to digest for many consumers, basically, who are at the end of every extended supply chain.
Patrick, we had a question on exactly that point. Do we think companies can have their cake and eat it too? Can they pull off more resilient, regionalized supply chains on the one hand, while maintaining cost efficiency, avoiding fueling the already overly high inflationary environment on the other? Critical question going forward.
I think that's at the core of every senior supply chain executive's mind right now, is needing to manage both the risks and that are associated, and making sure that that's being balanced through a lens of diversification and achieve the best possible cost at the same time. In fact, was having a conversation with a senior executive relatively recently, who was senior procurement executive, was describing precisely that tension, with all of the desire to be able to identify dual sources of supply, the desire from the senior executive from senior executive suite to be able to diversify our supply and decouple from China, we're under the same executive suite, we're under immense pressure to deliver year-on-year savings in an inflationary environment. And the reality of the current supply base and the way our current supply chain was configured is we are reinforcing in many ways the very relationships that we're trying to diversify away from because of the cost pressures that we're under in an inflationary environment. There isn't an immediate fix. There's the short-term reality of delivering on the margin pressures and the economic the economic value that needs to be created, together with thinking about and finding the right way to build the resilience and the adaptability and the flexibility. And I think that balance and that tension, which I think is very healthy, because as we start to think through finding new sources of supply or diversifying supply chains, it can't be done at any cost. It has to be done at a best cost and a competitive, which forces innovation, forces efficiency, that it creates further growth in new sectors and new areas that will continue to grow and develop. But we're going to see that, and we'll be living in that tension for I expect years to come.
Well, I wish we could hold you both hostage for a little while longer, but unfortunately, we've come to the end of our time here. But thank you very much, Pierre. Thank you, Patrick, for your very, very thoughtful responses here. Outstanding. And I'd like to thank the audience for your very interesting questions. I'm sorry we couldn't get to them all, but we've tried at least to take a few key ones. Let me conclude here by offering sincerest gratitude to our team at the Global Business Policy Council. Terry Tolan, the co-author of this report, Gabriella Hudart and Kevin Wolf, both of whom were instrumental in developing and surveying and compiling the results. And Alison McDougall for all the work that she has done for organizing this event. As I've mentioned, we will be sending to all involved in this audience a communication to help you get the text of our FDICI document on the one hand, and the details of our esteemed panelists who have weighed in on so many interesting topics here today. Very interesting time to release this Foreign Direct Investment Confidence Index. And thank you very much for joining us as we think through these results. And there are many friends from many places on this call. We send you our very best wishes. So thank you all, and we hope that you'll be joining us when we reissue the Foreign Direct Investment Confidence Index next year in 2024. Thank you all very much.
Thank you.
Thank you.